Hi, welcome to Let's Talk Bonds, the weekly bond podcast from INR Bonds. I'm Arjun Patsarthi. And in Let's Talk Bonds, I take investors and financial advisors through what's happening in the bond markets, what are the best options available for investors and for clients of financial advisors, and what are the best strategy to adopt in the bond market going forward, given the outlook. Now, today, things are looking very difficult in the market. Money is becoming very tight, and there is a lot of issues surrounding risk. The risk aversion in the market is very high. That's one of the reasons is because of the fact that the U.S. Federal Reserve and the European Central Bank and other global central banks are desperately fighting inflation and are raising rates very, very fast. And this is directly hurting the Indian rupee, which is now trading at record lows. And to protect the Indian rupee from depreciating too fast, RBI has been selling US dollars, and this is taking out all the money from the system. And apart from that, with the very high, with the record lows rupee value, the inflation is also, expectations are also rising, and this is hurting the interest rates as well. So in today's, that was Friday's government bond auction, we saw the 5-year government bond yield cutoff coming at 7.38%, and which is the highest in a month plus. This shows that interest rates are moving up very fast at the government bond. And now, if government bond interest rates move up so fast, then corporate bonds too interest rates too will move up very fast at the short time. There are short maturity bonds. Now, if you look at the private placement data, last week we had CEAT coming out with 4-year bond at 7.99%. Bangalore Airport Hotels Limit 5-year bond at 8.53%. Northern Capital coming out with 5-year bond at 10.07%. Tata Steel issued 5-year bond at 7.5%. Muthoot FinCorp issued 6-year bond at 10.04%. Muthoot Home Finance issued 10-year bond at 8.3%. Again, Tata Steel issued 10-year bond at 7.76%. REC came out with 10-year bond at 7.76%. And State Bank of India issued 15-year bond at 7.57%. REC was issued 10-year bond at 7.50%. And Punjab National Bank came out with the perpetual issuance at 8.3%. Now, what is going to happen in this tight money market is that the yields on all these bonds are going to go up. Now, 1-year corporate with 3-year, one year government bond closer to around 6.8%. 3 years closer to 7.3%, 5-year at 7.4%. Now, all the short end corporate bond yields will rise sharply. And we see that from where 2 and 3-year corporate AAA corporate bonds are trading at below 7%, 2 years, and 3 years around 7.5%, or 2 years maybe around 7%, and 3 years in a range of 7.2 to 7.3 to 7.5%. Now, 3-year, all these rates will go up. So we see the whole segment of the 1 to 3-year and 5-year corporate bond yields moving up very sharply, which is a good for bond investors because they will benefit from higher returns in investments in these bonds, especially good companies that are giving attractive returns. But investors have already invested in these bonds or through products like mutual funds will see a drop in value because the bond prices will fall because of rising interest rates. So hence, it is best to wait and watch because given that short-term interest rates are going to rise very sharply on tight money, and you could just well find that 1 to 3-year or 1 to 5-year bonds are earning very attractive returns from 7.5% to 8.5%. for good issuers, and maybe for yeah, lower down, less moderate risk issuers, yields could go up to maybe 10% to 10.5%. And very weak issuers will become weaker, and their yields will go up very sharply. But that fundamentally, they're going to find it very difficult to raise money from the market. And if you're a financial advisor, obviously the best place for you to understand which bonds to investment, how to design your client's portfolio, bond portfolio in this kind of a market. INR Bonds Partner Portal is the best place for you. We give you the full solutions on bonds with the most information, proprietary risk score, and the easiest of availability of the bonds, and ability to buy and sell bonds, and give you the full support after the investment as well. The investments through the INR Bonds Partner is very simple for your clients, and all you need to do is log into INR Bonds and sign up as a partner to get the full benefit of INR Bonds Partners and grow your assets under fixed income and help your clients save better.
As a financial advisor, my biggest responsibility is to help my clients make the right investment choices. Now, with INR bonds, buying and investing in bonds for my clients is quick and easy. With my guidance on bonds, my clients are happy and I'm getting new business every day. Register as a financial advisor on inrbonds.com to help your clients invest and save better through bonds.
Back to let's talk bonds. So the tight money is definitely going to be a worry, and this is going to hurt issuers who have a lot of bond outstanding coming up, and who do not have good liquidity support, and hence it's very important for them to preserve cash or try to raise as much as possible longer term debt. But the markets will not really entertain longer term debt from weaker companies, so that's part of the whole process. Hence, it is good for issuers to always broad base their borrowing, so through a mix of retail and institutional investors. Thank you for listening in, and if you do not forget to download our app, Quick Invest by INR Bonds, for the best curated list of bonds, the most information, transparency, proprietary risk score, and the easiest of in-app investment process. Download the app, select your bond, and get the bond in your DMAT the same day. Download the app now. And do follow us on all podcast channels.